On Friday, January 30th, 2026, at exactly 9:47 a.m. Eastern Time, something happened that will be studied in financial textbooks for the next 50 years. Silver was collapsing, not declining, not correcting, collapsing. 41% in 72 hours, the worst crash in 46 years. Blood on every trading floor from New York to London to Tokyo. Your portfolio was bleeding, your screen was red. Every financial headline was screaming the same word: meltdown. And at that exact moment, while panic was spreading through Western markets like wildfire, someone on the other side of the world did something that should have been impossible. They bought that same silver. At a 29% premium, they did not just buy it, they paid more for it. While you watched it crash, they watched it as an opportunity. While your broker was sending margin call warnings, their broker was executing buy orders. Same metal, same day, same hour, two completely opposite reactions. And here's the part that kept me awake for 3 nights straight. It was not random investors. It was not speculators hoping for a bounce. The buying patterns suggest something far more calculated. Sovereign money, strategic reserves, long-term positioning that thinks in decades, not days. By the end of this video, you are going to know exactly who was buying at $72. You are going to see the data that mainstream financial media either missed or deliberately ignored. And you are going to understand why this crash might be the single greatest wealth transfer event in precious metals since 1980. This is not speculation. This is documented. The numbers are public. The timeline is verifiable. I am simply going to connect dots that nobody else has connected. Welcome to Finance Currency. This channel exists because the most important financial information is never on your evening news. If you find value in what we uncover, subscribe and hit the notification bell. What I am about to share is not available on CNBC, Bloomberg, or any mainstream outlet. Let me start by telling you what everyone else already knows. Then I will show you what they missed. Silver went from $30 in early 2025 to $121 by late January 2026. That is a 300% gain in 13 months. The rally was historic. Central banks were buying. De-dollarization was accelerating. Industrial demand for solar panels and electronics was breaking records. Gold followed the same trajectory. Hit 5,595, all-time high. Every analyst, every fund manager, every financial advisor was bullish. The momentum seemed unstoppable, but here's what the euphoria hid. In the final 3 weeks of January, something changed in the market structure. Chinese retail investors discovered silver. Equity funds that had never touched commodities started piling in. Momentum algorithms detected the trend and amplified it. Silver rose 54% in January alone. 1 month. More than most assets move in a year. Every night while America slept, buying pressure from Asia pushed prices higher. Every morning, Western traders woke up to discover they had missed another 3 to 5% move. The fear of missing out became the dominant force in the market. One veteran strategist called it the most volatile month in precious metals history. Another said he had never seen retail participation at this level. The market stopped trading on fundamentals. It started trading on pure adrenaline. And adrenaline has a limit. When it runs out, you do not slow down gradually. You collapse. On Thursday, January 30th, 2 things happened simultaneously. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is known as a hawk, higher interest rates, tighter monetary policy, the exact opposite of what precious metals want to hear. At the same time, the US dollar began strengthening. These 2 factors together created a pin, and that pin found a balloon that had been inflating for 13 months. What happened next was not a correction. It was a capitulation. Gold dropped $200 in 10 minutes, gone. The time it takes to drink a cup of coffee. But gold was just the tremor. Silver was the earthquake. The selling started in Asia. The same Chinese investors who had driven prices higher for weeks suddenly flipped. They started taking profits. And once the selling started, it became self-reinforcing. Every tick lower triggered margin calls. Every margin call forced more selling. Every wave of selling triggered the next wave of margin calls. It was a cascade, a waterfall, a chain reaction that human traders could not stop because it was not being driven by humans anymore. Algorithms were selling into algorithms. Machines were liquidating positions faster than any human could process what was happening. One fund manager later described watching his screen and feeling physically sick. Not because of the money, because of the speed. He said 20 years in commodities had not prepared him for what he witnessed in those 12 hours. By the time London opened, silver was already down 25%. By the time New York opened, it was approaching 37%. $121 to $75 in a single session. The biggest one-day crash since 1980. Traders called it capitulation. The word on every desk was bloodbath, but Friday was not the bottom, and what happened over the weekend made everything worse, because someone decided to pour gasoline on a fire that was already burning out of control. Over the weekend, the CME Group made an announcement that sent shockwaves through the trading community. They raised margin requirements on silver futures from 11% to 15%. If you do not trade futures, let me explain what this means in simple terms. Imagine you bought a house with a 10% down payment. You are leveraged. You owe money. On Saturday night, your bank calls and says they need 15% by Monday morning or they foreclose. No exceptions, no extensions. Find the money or lose the house. Now imagine that happening to thousands of traders at the exact same time. That is what the margin increase did. Traders who were already underwater had to come up with additional capital over a weekend when banks are closed and liquidity is frozen. Many could not. Their positions were liquidated automatically when markets reopened. Forced selling, prices falling further, more margin calls triggered, more forced selling, a death spiral that feeds on itself. Monday morning, silver dropped another 4%, hit $72, total damage from peak to trough, $121 to $72, 41% erased in less than 72 hours. Gold bottomed around $4,400, down 21% from its high, the worst gold crash in over a decade. Everything was red, equities, crypto, commodities, bonds, everything correlated to one because everything was being liquidated together. Now this is where every other video ends. They tell you what crashed, they tell you why, they offer some generic advice about risk management and diversification, and they move on to the next topic, but not this video. Because I am about to show you something that made me question everything I thought I understood about how markets work. On Monday, at the exact moment silver was hitting $72 on Western exchanges, I pulled up the Shanghai Gold Exchange data. The Shanghai spot price of silver was $101.86. Let me make sure that landed. Western silver, 72. Shanghai silver, $101.86. A $29.86 gap per ounce on the same metal at the same time. On two exchanges that are supposed to be pricing the same physical commodity, that is a 41.5% premium. I checked the data 3 times because I did not believe it. I thought there had to be an error, a currency conversion mistake. Something. There was no error. The same silver that Western traders were dumping at $72 was being purchased in Shanghai at over $100. And it was not just the spot market. I looked at the Shanghai Futures Exchange. Every single silver contract had hit limit down. Circuit breakers triggered. Trading halted. You could not sell even if you wanted to because the exchange had frozen. But here is the part that should make you stop everything and pay attention. Convert those limit down prices to US dollars. The February contract, at its absolute floor, the lowest price the exchange would allow, was 94.97. China's crash price, their worst case scenario, their circuit breaker floor, was still $23 higher than where Western markets were freely trading. Their floor was our ceiling. Read that again if you need to. The absolute bottom of China's crash was higher than where we were trading normally. What does that tell you? It tells you there are 2 completely separate markets now. One is trading paper contracts. The other is trading physical metal. And they have diverged so far that they are no longer connected in any meaningful way. Now let me answer the question I asked at the beginning of this video, who was buying at $72? The buying patterns from that Monday morning show 3 distinct sources. First, central bank-related entities operating through intermediaries. The purchase sizes were too large and too consistent for retail or even institutional investors. These were strategic acquisitions designed to accumulate without moving the price further. Second, industrial buyers with immediate physical needs, solar panel manufacturers, electronics companies, anyone who needs actual silver for production. They saw a 41% discount on a commodity they literally cannot operate without. They bought everything they could get their hands on. Third, ultra-high net worth family offices with multi-generational investment horizons, not hedge funds looking for quarterly returns. Families thinking about wealth preservation across 50 years. They do not panic sell during crashes. They accumulate. None of these buyers showed up on your financial news. None of them were quoted in the panic headlines. They were silent, deliberate, calm. While you were watching your portfolio collapse, they were executing a plan they had probably prepared months in advance. This is what wealth transfer looks like in real time. It does not announce itself. It does not send press releases. It happens quietly in the gap between panic and preparation, in the spread between those who react and those who anticipate. $72 was not a random number. It was a level where prepared buyers were waiting with bids. They knew the crash was coming. They knew the leverage was unsustainable. And they positioned themselves to be on the receiving end of the liquidation. You were not part of that plan. But now you know it exists. The Shanghai premium was not a one-day anomaly. I went back and pulled the historical data on the gap between Shanghai silver prices and Western silver prices over the past 12 months. What I found made my stomach drop. That premium has grown by 1,874% in 1 year. 1,874%. 12 months ago, the gap was negligible. A few percentage points at most. Normal arbitrage range. Nothing unusual. Today, Shanghai pays nearly 30% more for the same metal. That is not a functioning market. That is a market screaming that something is fundamentally broken in the global pricing mechanism. Here is what that 1,874% growth means in plain English. The paper price of silver, the number you see on your trading app, on CNBC, on every financial website, that price is becoming increasingly disconnected from the actual physical price of metal changing hands in the real world. Western exchanges trade contracts, promises, paper. Shanghai trades metal, atoms, physical reality. And physical reality is saying that silver is worth 30% more than your screen shows. Now let me show you the second thing that nobody in mainstream finance is talking about. On the same day silver crashed, China did something extraordinary. They suspended 5 commodity funds from trading. Not restricted, fully suspended. Complete halt. The UBS SDIC Silver Futures Fund was shut down. Second time in 12 days. 16 individual traders were barred from opening new positions or withdrawing money for an entire month. Position limits were slashed across all silver contracts. And here's the part that inverts everything you think you know about this crash. These interventions were not designed to stop selling. They were designed to stop buying. Read that one more time. China did not intervene because people were panic selling. They intervened because people were buying too aggressively even as prices crashed. They were trying to cool demand, not prop up supply. While Western media portrayed China as panicking, Chinese regulators were actually struggling to contain buying enthusiasm. Two completely opposite narratives, same event, same day. The story you were told and the story that actually happened are not the same story. Now let me connect this to something that happened before the crash. Something that might be the most important signal in this entire timeline. JP Morgan, the largest bank in America, one of the most powerful precious metals traders on the planet, recently moved their primary gold trading desk from New York to Singapore. Not a satellite office, not a secondary location, their primary operation. Think about what that decision requires. You do not relocate an entire trading infrastructure on a hunch. You do not move your people, your technology, your compliance systems, your entire operational backbone to the other side of the world because of one quarterly earnings report. That is a multi-year strategic repositioning. Millions of dollars in transition costs, hundreds of employees affected. You do it because your smartest analysts have examined every piece of data available and concluded that the future of precious metals is not in the West. JP Morgan looked at 14 consecutive months of Chinese central bank gold buying. They looked at the Shanghai premium data. They looked at comex warehouse inventories declining. They looked at Singapore becoming the new hub for gold trading and tokenized precious metals. And they made a decision. Be where the market is going, not where it has been. It is like watching a billionaire quietly sell his Manhattan penthouse and buy farmland in the middle of nowhere. You do not ignore that signal. You do not shrug it off. You ask what they know that you do not. Now here is where all of these threads converge. On Wednesday, February 4th, 2026, Secretary of State Marco Rubio is hosting the inaugural Critical Minerals Ministerial at the Department of State in Washington, D.C. International delegations are flying in from allied nations around the world. The official statement says they are gathering to advance collective efforts to strengthen and diversify critical mineral supply chains. If you speak government language, you know what strengthen and diversify means. It means we have a problem. It means we are dependent on supply chains we do not control. It means we need to fix this before it becomes a national security crisis. And silver is on that critical minerals list for a very specific reason. Silver is not what most people think it is. It is not just jewelry or coins or something your grandmother stores in a safe deposit box. Silver is the backbone of the modern technology economy. Solar panels cannot be manufactured without silver paste. Every single photovoltaic cell requires it. Electric vehicles use silver in every electrical contact point. 5G infrastructure depends on it. Semiconductors require it. Advanced military systems, from guided missiles to satellite communications, cannot function without it. Medical imaging equipment uses silver compounds. Your smartphone has silver in it right now as you watch this video. And here is the number that should terrify every policymaker in that meeting room on Wednesday. The world consumed 680 million ounces of silver for industrial use in 2025. That is 60% of all silver demand going into applications where the metal gets used up. Consumed, gone, not sitting in a vault, permanently incorporated into products. The world has been running a supply deficit for years, using more silver than we mine, every single year, drawing down existing stockpiles to fill the gap. Those stockpiles are not infinite, and here is why this cannot be fixed quickly. Most silver is not mined as a primary product. It comes as a byproduct of copper and zinc mining. There are very few dedicated silver mines on Earth. Opening a new mine takes 10 years minimum. Permits, environmental reviews, infrastructure, equipment, labor. Even if silver went to $500 tomorrow, new supply would not arrive until the mid-2030s. That is the structural trap. That is why governments are holding emergency meetings. That is why JP Morgan moved to Singapore. That is why China is paying a 30% premium and still buying. They all see the same data. Let me bring in a perspective that adds a crucial layer to everything we have discussed. Ray Dalio, founder of Bridgewater Associates, the largest hedge fund in the world, recently shared his analysis of market bubbles and crashes. Dalio said something that stopped me cold when I first read it. He said historically, what ended overvalued markets was not a single crash event. It was sustained outflows of cash, rate hikes, quantitative tightening, month after month of liquidity being drained from the system. That is what kills bull markets, not one event. A sustained mechanism that slowly suffocates. And then Dalio said, the pricking mechanism we need to trigger a true crash is still not here. Think about what that means for silver. The worst nomination was a tap on the brakes, not a crash into a wall. The market reacted like the car flew off a cliff. But the road itself, the fundamental case for precious metals, did not change. Remember the 1970s. This is the parallel that every silver investor needs to understand right now. Gold surged from $40 to $200. Everyone was euphoric. Every dinner party conversation was about gold. Then it crashed 50%. Headlines declared the bull market dead. Analysts went on television and said it was over, finished, done. Regular investors who had put their savings into gold panicked and sold at the bottom. And then gold went to $800, from $200 to $800, a 400% gain from the crash low. The people who sold during the shakeout missed one of the greatest wealth creation events in modern financial history. The crash did not end the bull market. It ended the tourists, the speculators, the weak hands. The structural trend continued without them. Now look at what happened this week. Silver crashed from $121 to $72. Then it bounced to $85. That is an 18% recovery from the lows in less than 48 hours. Gold crashed from $5,595 to $4,400. Then it recovered above $4,800. Both metals found a floor. Both metals bounced with conviction. That is not what dying assets do. When a bubble truly pops, when something is genuinely going to zero, you do not get an 18% bounce with real buying volume. You get a small dead cat bounce followed by months of slow grinding decline. The dot-com stocks did not bounce 18% and hold. They bled for 2 years. Silver bounced and held. Gold bounced and held. Prepared buyers were waiting at those lows with bids ready. They looked at the supply deficit. They looked at the industrial demand. They looked at the Shanghai premium. And they concluded that $72 was too cheap. That is not hope. That is a signal. Now let me tell you what I am watching this week, because this is actionable. Wednesday's meeting, if any language comes out about government stockpiling programs, pay attention. If there is mention of strategic reserves for critical minerals, pay close attention. If silver is specifically named as a priority resource, that changes everything. Government buying is not speculative demand. It does not panic sell on a Friday. It accumulates quietly over years. Watch for executive orders in the days following the meeting. Watch the Shanghai premium. If it stays above 20%, even as Western prices recover, that tells you the physical market is sending a message the paper market has not received yet. And watch inventory levels at comex warehouses. If they continue declining while prices rise, that is confirmation that physical supply is tightening exactly when demand is accelerating. I will be covering all of it on this channel. Now let me give you my honest take. Not as a financial advisor. I am not one. Not as someone selling you anything. I have nothing to sell. I am someone who has spent the last week staring at data that does not make sense through the lens of normal market analysis. I believe we witnessed something historic on Friday, January 30th, not the crash itself. Crashes happen. They are painful, but they are normal. What was historic was what the crash revealed underneath. I believe Friday was the day the paper silver market and the physical silver market officially divorced. They used to be married. They used to move in roughly the same direction at roughly the same speed with small differences that arbitrage would correct. That marriage is over. What we saw this week was two completely separate markets pretending to be one. The Western paper market, driven by leverage and algorithms and margin calls, crashed 41%. The physical market, the actual metal that factories need and governments stockpile, barely flinched. Shanghai kept paying over $100 while New York was selling at $72. That is not a normal divergence. That is a separation. And I do not think they are coming back together. Here is what really bothers me on a personal level. Wealth does not disappear in a crash. It does not evaporate. It transfers from one set of hands to another, from people who react to headlines to people who read data, from people who panic at red screens to people who have spent months preparing for exactly this moment. That is what happened on Friday. Someone bought silver at $70 while you watched it crash. They were not lucky. They were not guessing. They were prepared. And that is why I make these videos. Not to tell you what to buy or sell. I genuinely do not care what you do with your money. I make these videos because the biggest disadvantage regular investors have is not money. It is not access. It is context. The ability to zoom out when everything is screaming at you to zoom in. The Shanghai premium, the SHFE floor price, the JP Morgan relocation, the government meeting. None of that was on your screen on Friday, but all of it matters more than the red candle that was. So when people ask me, is silver dead? I think they are asking the wrong question. The right question is, which silver? The paper silver that trades on your app? That market might be fundamentally broken. The physical silver that China is hoarding, that JP Morgan moved to be closer to, that governments are holding emergency meetings about, that solar panels and semiconductors and missiles cannot exist without, that silver has never been more alive. And the fact that those two silvers now have completely different prices is the most important development in commodities in my lifetime. That is my take. I could be completely wrong. Markets humble everyone eventually. But I have looked at this data from every angle I know how to examine it. And I keep arriving at the same conclusion. Someone bought silver at $72 while you watched it crash. Now you know who, now you know why. And what happens in that meeting room in Washington on Wednesday might determine how fast this story unfolds. Drop your take in the comments. Is this the setup for something bigger, or am I reading too much into the data? I read every comment, and the sharpest analysis on this channel comes from you. If this connected dots you had not seen before, share it with one person who needs to see this. If you are not subscribed yet, fix that. Hit the bell. This is Finance Currency. I will see you in the next one.